In this video, I'm going to show you both how to build a whale-resistant bot that can still target 1% a day, and how to recognize and avoid the traps whales lay in real time, whether you trade with a bot or by hand. You'll see how to create alerts that help you stay ahead of spoofing, how to confirm real trades with volume, and how to train your bot to stop behaving like a snack. If your bot ever bought too soon, or your stop loss got crushed right before the bounce, you're about to learn why and what to do next. If your stop loss gets taken out just before the reversal, if your bot buys dips that feel more like bait than opportunity, you're not trading badly. You're trading in whale-infested waters. Let's fix that. Whales love predictable bots. Whales don't fear automation, they count on it. They've studied how bots behave, and they know what to expect when you trail your buys too tightly, exit too early, or panic at obvious levels. The more consistent your settings, the easier you are to trap. What they can't control is a bot that thinks for itself. Can you beat them with a bot? You can, but not by following someone else's template. You need a bot that responds to signals like a trader, that waits for proof and knows when to stand down. A bot like that starts with good logic and smarter defaults. Entry fix. Stop buying too early. A lot of bots are set to buy when price drops by 2%. That's too predictable. Whales drop the price just far enough to trigger those early buys, then reverse the trend once you're locked in. Instead, try something a little less obvious, like 2.2 or even 2.35%. That tiny change can slip past the traps. Entry script customization. If you're using a custom bot script, most of this is fully adjustable. You can fine-tune your entry thresholds to avoid common triggers, and even build in conditions that reference volume, delta, or signal lines. We're not diving into script modifications in this video, but if you want to see a walkthrough of how to build or edit that kind of logic yourself, let me know in the comments. Safety order fix. Spread it out. If your bot is stacking safety orders too close together, you're not managing risk, you're feeding it. Whales expect that kind of overcommitment. Instead, give your bot more space. Enter at market, then place your next orders further apart, 3% down, then 6, maybe even 10. You don't need to chase the dip. You need to let the market prove itself. How to find safety order settings plus layered logic. In 3 commas, you'll find your safety order step settings right inside the bot. Look for safety order step scale. That controls the spacing. Then check order volume scale if you want to adjust how much gets deployed each time. Now, layered logic comes in when you start attaching conditions to when those orders activate. Instead of placing all orders no matter what, you build logic that says only add another order if Vidya is rising, or only DCA if volume is above average. It turns your bot into a decision maker, not just a trigger. Stop loss fix. Ditch the blind exit. If your bot is using a basic stop loss, something like sell if we drop 5%, you're not protecting your trade. You're waving a flag that whales can target. A real whale-proof strategy exits only when multiple things go wrong. In 3 commas, that means using composite conditions. Instead of one percentage rule, combine indicators. You might close a trade when momentum shifts bearish, delta flips negative, and volume confirms the drop. It takes a little setup, but it lets your bot think in layers, just like you would if you were watching the chart live. Where to find these indicators and settings? All your condition logic lives inside the bot builder in 3 commas. To find your exit settings, go into Deal Close Conditions. From there, select Custom Condition, and you'll be able to choose indicators like RSI, EMA, or VIDIA, and combine them with metrics like price movement or trailing stop. You can even plug in delta volume indicators if your TradingView alerts are linked by webhook. Once you understand this, you're not just reacting to price, you're responding to market structure. Take profit fix, let winners run. Trailing take profit, or TTP, is your best friend here. TTP means your bot will keep following the price upward and only close the trade if it starts to come back down. It locks in gains without limiting your upside. A fixed take profit might grab you 1.5%, but if the trend keeps rising, you've left profit behind. TTP captures more of that move, and you can fine tune how close the trail follows. Tight for short swings, wider for strong trends. What TTP does and why it matters. TTP works like this. Once your trade hits your profit target, instead of closing right away, it sets a trailing buffer. If price keeps climbing, the bot stays in. If price reverses and cuts back into the buffer zone, then the bot exits. It's like saying, I want more, but I won't get greedy. You'll find this in your bot settings under Take Profit Type. Select Trailing and adjust your callback rate. That controls how close the bot trails price action. Wider trails give more room. Narrower ones lock profit faster. Timing fix. Pause in whale waters. Spoofing doesn't just move price, it distorts behavior. You'll see fake buy walls appear, order books pulse with sudden size, and delta volume flip back and forth like a strobe light. If your bot trades through that, it's gambling, it's not trading. Where to watch for delta and spotting the order wall. In TradingView, use the volume delta or CVD indicator. Search for it under Indicators. This shows you the balance between buying and selling pressure. In 3 commas, when your deal is open, you can view delta in your charts volume panel if you've connected your TradingView strategy. To see an order wall, you'll need to open your exchange's order book. Kraken, Binance, and most major platforms show this live. Look for a sudden spike in size just below or above the market price. That's the wall. Now, bots can't pause themselves on most platforms unless you've added external triggers. So if your platform allows webhook or TradingView alert integration, you can set an alert to auto-disable the bot during spoofing. Otherwise, you pause it manually and re-enable when the water clears. Want even more control? Use alerts. Here's the most underrated tool of all: alerts. Not auto trades, not panic orders, just knowledge. How to set alerts quick and clean. On TradingView, right-click any price level and choose Add Alert. You can set conditions based on price crossing, indicator changes, or even volume thresholds. Want to know when delta spikes? Set an alert to notify you. Want to be warned before your bot enters? Set an alert 0.2% above your planned entry. Now you're acting from awareness, not reaction. How to confirm with volume. Spoofing fakes price, but it rarely fakes volume because real volume has weight. What volume confirmation looks like. If the move is real, you'll see tall volume bars growing with the candle. Price rises and volume rises with it. That's strength. But if the candle moves with thin, flat volume, or volume stalls mid-candle, that's a trap. Look at the delta. If delta hesitates or flips, you're looking at a move that lacks commitment. Wait it out. Can you still make 1% daily? Yes, if you stop bleeding it away. If you avoid traps, confirm your moves, and exit wisely, you can make 1% daily without forcing trades. You don't need 20 hits. You need 3 wins that aren't fake. If this gave you clarity, if it gave your bot a backbone, follow for more. I'll keep building out both sides, how to automate with real edge and how to recognize danger with your own eyes.